in. I'm Lisa and you're watching Money Z's. As we move into our investing segment, let's begin by talking about investments which give you a safe return. Now, when we think about safety, it could be for one or two reasons. Firstly, it could be because you need the money in the very short term, say 2 to 6 months, and you cannot afford to take any risk with the capital. So you want to keep it in something which gives you extremely safe and stable returns. Secondly, it could be that the purpose of the investment is such that you require safety. For example, building your emergency fund. Now, that is a case where you don't know when you'll need the money. You could need it 6 months later or 5 years later or next month, but you at no point in time can you risk your capital. So these could be the two reasons why you're looking for a safe return product. Now, where do we begin? What is the most safe thing that you can buy? A financial product that is backed by the government. So there are government bonds which you can buy. However, most of them are long term in nature. They are not flexible, so you don't have access anytime, and they do not suit that short term requirement of 2 to 6 months. But there are government bonds which are listed on stock exchanges which you can buy, but it is difficult for an individual investor to go and buy those from exchanges because the per unit value could be a lot and it may not suit you, plus there isn't enough liquidity when you're buying from the exchange. The option or the alternative is to buy debt mutual funds which invest only and solely in government bonds. Those are extremely safe and they give you the option of buying and selling whenever you need to. The second thing that comes to mind when you think of a safe return investment is, of course, bank deposits, and those are the preferred route we know in India. However, the danger with bank deposits is that the interest rate could be lower than inflation, which means your money could degrow. The good thing about bank deposits is that it's available at every tenure. So, 30 days, 45 days, 6 months, 6 years, 10 years. So you can use it for your requirement of any period of safe returns. However, you have to be careful about interest rate. If the interest rate is too low, you risk losing money because of inflation. If the interest rates are rising in the economy, you risk tying into an interest rate which is low while everything else is giving you something of a higher return. Then, of course, there is something called the Public Provident Fund, which is really a good option. But here also it's a 15-year locked-in product. So this is for your long-term debt allocation, which requires safe return. It is tax-free on returns of all kinds, interest and the money that you get back. So it is a good option in that sense. Then we come to debt mutual funds. Now, debt mutual funds are structured in a way that they can cater to your very short-term safe return requirements or long-term safe return requirements. However, you need to check a few things very carefully: quality of the portfolio, consistency of return historically, and of course, you have to be sure that the tenure that you are looking to invest for is matched with the maturity profile of the fund. Now, of course, these things look a bit complicated, and that's why perhaps people prefer bank deposits over debt mutual funds. Nevertheless, give it a shot, because once you start investing in them, the flexibility that they offer and the relative safety and stability that they offer are good options when you're looking for safe returns. Now, let's also talk about gold, because that is one thing that people consider quite a safe investment. However, the trouble with gold is that there is no other source of return other than price. And while in the last 1 year you've seen gold price shoot up, actually for 7 to 8 years before that, price was either moving lower or sideways. So gold prices are not reliable in that sense. I can't say that it's a very safe investment. However, over a long 10 to 20-year period or even 8 to 10-year period, gold returns do match the inflation in the economy. So in that sense, it does help you preserve the value of your money. So you could use it for that, but keep your allocation at the lower end and don't go overboard on gold. Remember, when you are looking for safe returns, your best bet is to chase quality. Don't chase that 1% extra return, whether it's bank deposits, whether it's company deposits, whether it's debt mutual funds. Don't chase that extra return, because it will come at a cost and safety will be compromised thanks to quality, not thanks to structure. So take care of that. There are a lot of safe return products available in the short and the long term, but quality is what you should be concerned with the foremost. Thank you for watching. I'm Lisa. Do log into moneypuzzle.in for all your personal finance queries.